everybody. I guess the good thing about following Skull Burger on stage is that even the evening after the gala dinner, we've got a full venue, even if it wasn't necessarily to listen to me. Thanks, John, for the introduction. I think the deep diving into the industry has actually been done by my colleague Kandas, who's sitting in the audience here, so I've got her name in the presentation as well. She's did a lot of the work that you'll see. So I'll be presenting and she'll be answering the difficult questions. So let's see where we go. Let's start with some good news. I think maybe just for some context before we get into the work that we did. Citrus in South Africa, it's obviously a big contributor to agriculture. I think we've heard that before. It's 7% of the gross value of production of agriculture. And if you just look past over the last 5 years, we've seen growth of 9% per annum. So that's obviously very impressive performance. If one looks at exports, that's just plotting South Africa's largest export industries within the agriculture and food sectors. It's an average from 2019 to 2013, and you'll see that citrus towers obviously above all the other ones. So a lot of the fruit products coming out strongly, but citrus being the major one. And then, of course, it's also one of our biggest employers in agriculture. So 140,000 people currently employed in the sector. It's expanded very rapidly. I think we've heard that as well before today, yesterday in particular, but just look at that area chart. So there we've got area under the various products. The percentage changes is for the last 10 years, so 21% growth in oranges, in excess of 400%, but 23,000 hectares of soft citrus. All of them expanding very quickly. We all know that that's one of the factors that's arguably contributing to where we find ourselves now. If you just look on the right, that just gives some new perspective, again, on the amount of young orchards that's still waiting to come into production. We've put soft citrus up there, which is probably the one where it's the most extreme, so it illustrates it the best. Then in the table at the bottom, we're just showing the various products, the average age of the national orchard. So there you can see soft citrus, obviously the youngest, the contribution in total in terms of area in South Africa. And then also the contribution to volume. And there you can see, again, soft citrus, the outlier compared to the other ones, in that it's contributing less to volume than what it is to total area. That's because of all those young trees that's still waiting to come into the system. And then also the contribution to the gross production value. Obviously, you have to also see this from a regional perspective. So there is differences across regions. The charts on screen showing on the left-hand side just where the area is, so the share of each product in national area, so the share of that province in national area for each product, let's put it that way. On the right-hand side, again, the average age distribution per province. Again, you can do this, you can break it down further, you can look at smaller production regions. But even at this level, it just gives some indication as to where the hectares are, where the investment occurred, where the younger hectares are situated. If you look up north, your youngest soft citrus hectares, their average age of 5 and 7 years. If you look down south in the Western Cape, for instance, your orange average age is 30 years. So it gives us some indication of where the new volumes are likely to come in, where it will have to move through in terms of ports, in terms of logistics. And also, if we start letting older orchards come out of production in order to manage volume, where that could likely occur. This is exports. Again, if you look at the first part of the chart, we're still on the good news part. That's just showing the rapid growth in exports that we've already seen. If you look at those percentages, just in the last 3 years, 31% increase in oranges, soft citrus in excess of 80%, lemons and limes more than 60%, just in 3 years. So really massive growth in volume. I guess the less not good news is what you see going into the outlook. And I think there it's quite striking if you look at the shape of my export projection there versus what Justin, for instance, was showing yesterday in the Vision 260. And I think this brings us maybe just to a point worth pausing in terms of where these numbers come from. I think many of you have seen some of them before. It's based on work that we've done started last year. This is the second round this year with Justin and team from CGA. So the market model, the exports here is being generated by a partial equilibrium model, which basically considers the economic environment, exchange rate, consumer spending power, those demand aspects, and then also your cost of production, etc. on the supply side, your prices. So what it does is it tries to simulate decision-making based on economic principles. So your producers making decisions based on profitability, your consumers making decisions based on income, spending power, and prices. And where these two meet gives you an equilibrium price. So this is what the economics is telling us, that exports will flatten off a bit. And I think having heard yesterday and all the challenges the industry faces, that makes sense. On the other hand, we do know there's a lot of trees in the ground, which is going to give us a lot of additional volume. So I think I'll say up front now that this is a baseline. We generate a baseline saying where are we headed if things stay as they are. So if we continue in a business as usual sort of frame, where are we headed? This is that picture. I think our challenge is marrying this picture with the Vision 260 numbers and saying how do we make those numbers sustainable and get there as opposed to here. So the baseline, it's, I guess, in some sense, is laying down the challenge to us. As I've said, there's many things influencing that position. I'm going to run through them fairly quickly because a lot of them have been discussed in detail already yesterday. The one is the global economy. These are growth prospects from the IMF, their latest release in January. There you can see global growth downgraded to 2.9%, just below 3%. But look at the advanced economies, 1.2%. Look at the EU, 0.7%. So really coming under pressure there. Central banks are dealing with the issue of inflation. And it's a very delicate balance, trying to maintain growth but also control inflation. So I think many would argue that there's still a significant risk of recession in some of these major economies. Just logistics, again, cost of logistics. So that's just showing the rate to move reefer containers. 2020, 21, 22, you can see how that ramped up. I think if you were to draw a trend line, it would be certainly an exponential one, looking at that. 2023, we've just put some indicatives in there in terms of how much it would have to decline to get to various levels. So the blue line is I think, 20%, and then 35%, and then 50% decline, where that would put you relative to the past few years. Then, of course, I don't need to say anything about port congestion, interruptions in port, and just the general deterioration in our infrastructure in the country. I think Mitchell did a whole presentation on it yesterday. Increasing severity of load shedding, again, I think that's been well noted. Many challenges across the value chain, not just at producer level. The slow pace of new market access is obviously a challenge that influences many, and then there's the competitiveness of market access, particularly in Asia. So here we've just pulled up some numbers. These are tariff rates that we face in some of the major Asian markets, more than 100% in Thailand, 80% South Korea, 30% in India. And then the left one is a table that you might have seen before. We have shown it often, and we will continue to do so. But I think this just speaks to the need for more competitive market access. This shows the preferential trade agreements that we have as South Africa with major trade partners in Asia, as opposed to our competitors. So basically, if the block is green, there's some form of agreement where you pay a lower tariff than what any general country does, and if it's red, there's nothing. And I think that picture is quite clear in terms of we are generally on the normal, on the most favored nation tariff, where a lot of our competitors have some preferential agreement in place. This is my last slide on the challenges. The substantial increase in input costs, I guess I don't have to tell anybody about that again. But if we just look at a composite index that we compiled there for oranges as the biggest one, 26% in 3 years, that's very sharp increase. And then the other one that we're showing, the green one, is just labor, and that's compiled from minimum wage information. So it's obviously a big cost contributor to the citrus industry. The change in the EU cooling protocols, this is based on some work that Kandas did last year. So what you see there is the two options available at this point for this year. Both of them probably will entail the need to expand forced air cooling, which has some capital, some infrastructure investment. And then that would be the cost of the industry in terms of using either method. Overall, looking at 6.50 Rand to 8 Rand per carton, right, Kandas? She's nodding her head. So, and then just more generally, so we also heard Dion speak yesterday about the CBS, the FCM. So the last time we did the survey work was in 2021, based on 2020 data. Then we put the cost to the industry of those protocols at 3.3 billion. I think we heard a bigger number from Dion yesterday. So obviously, if you inflate based on 2021 trade numbers, 2022 trade numbers, this cost is also escalating over time, and there's things like inflation to consider. There's obviously differences also in terms of regions, where the product goes. So this is some work that we put together looking at the price that we can get in various markets, accounting for differences in shipping costs and what that would imply for our bottom line. I think why we show it here is twofold. Firstly, if you look at Europe, based on last year's data, that was already negative. So there's not a lot of capacity there to absorb additional costs in order to supply that market. So I think that's probably my first key point. The margins are better in the Far East, which one can see why there's product being targeted in that region. But then lastly also, if you just look at the bottom one, how fine these margins are. I think in many instances, we're talking cents. We've got a super long value chain. We're talking cents between negative and positive. It's obviously a high volume game, and then per unit, it can be very small margins. So if we can make a small difference at a few points in this value chain, we can turn this around to get it more sustainable in the longer term. Again, just summarizing the various risks that are influencing us currently. Maybe just to highlight a few, I think many of them have been spoken about, but one that we maybe haven't said too much is load shedding. So obviously, when a cold chain is critical, load shedding makes additional challenges. So this is a key factor to consider. Things like exchange rate volatility, weather, risks of conflict and social unrest in the country as we're in this cost of living crisis, all of these things come up. And then there's some international ones which we probably can't do much about. We do have some key competitors expanding as well. If we think of a country like Peru, obviously the freight rates is an issue. I spoke about the risks of recession, the conflict in Ukraine. There's a lot of external factors and there's a lot of internal factors that are influencing our horizons. So what does all this imply? This is our latest view as to area projections. I think this is not such a nice picture as you probably would want to see. This suggests that based on the economics of it, area is going to pull back a little bit. As I said, this is purely an economic decision-making model. So if you look at, and you'll see the financial positions currently from the farm level simulations that back this, that suggests that we probably might lose some people. Some people might cut back, might control, might manage volumes a little bit, which then brings us to this position. And if you contrast that, if you look again at growth over the past 10 years, the last decade, that was 40,000 hectares added. But then we lose some of that in the short term before we stabilize under this baseline condition. What does that imply? Maybe this is better news, I don't know. But the result of that is that we get to more sustainable prices. Ultimately, you've got to carry a business and you've got to be sustainable to stay in business. So what we're showing here on the left is just an index of prices. These are export prices. Of course, there's other market segments also to consider, but we focus on exports being the biggest one. And then there's costs on the right-hand side. And if you just look at that period, 2020, 21, 22, how the prices have fallen and the costs have increased, I think it's clear why we find ourselves in the challenge that we currently do. The good news is based on that production pulling back a little bit, we see that bottoming out in 23, 2024, and then from there we start to get a little bit better. On the cost side, obviously some won't decline. Things like labor costs will keep increasing, but then there's others, things like fertilizer, etc., where we do see some respite on the horizon based on what's happening internationally and also exchange rate dynamics that we're working with. What we then did is pulled all of that back to a farm level simulation. So the model that I described earlier, that's the market model, that's my baby, that's what I keep myself busy with. This is the farm level model. That's Kandas' baby. That's what she keeps herself busy with. And she's been touring across the different production regions over the last 6 weeks or so, visiting probably many of you sitting in the room for information. So on that note, maybe also just to say thank you to everyone that works with us, that provides input into these numbers. It's really critical to get this right, to be able to build these models and show you where it's standing. So what you see on screen is very much a hypothetical type of farm. So it's one that we've put together based on the national aggregate information. It doesn't exist in reality. It's just an indicative product. We've got one of these for each of the main production regions, and then we've got the national one. We'll focus on this one today, purely because we don't have all day, so try and stick to the 30-minute barrier here. That gives you some indication of how it's structured in terms of product mix. So it's a 100-hectare farm, 51 of those under oranges, 25 under soft citrus, 19 under lemons. Obviously, any individual farm will look different in terms of the composition of the different products. It will look different in terms of the composition of the different markets, your exports versus your local fresh versus your processing. And for that reason, the results can be very different. Again, the purpose of this one is to show you what we see at market level. What does it actually imply on the bottom line for a producer? And I think it's just a nice way to illustrate what these implications are. We tend to show the information at EBITDA level. Of course, there's still things that still need to be paid. I think there's bankers in the room as well, so there's still interest, there's still capital, there's still some stuff that need to happen after that. But if it's difficult to get to that point with a farm that's sort of kind of representative, it gets even more difficult once you start considering asset structure, financing structure, etc. So we stop at this point and we note that those structures will vary across the various producers, and there's still that component to be accounted for from the numbers that we show. So let's get to those then. For those of you that saw last year's round of presentations, at least this one looks a little bit better than the previous round that we showed, I guess, in the longer term, although the area reflects what it takes to get there. So to me, it's still not really the picture that you want to see, but at least this is starting to get in the longer term a bit more sustainable. This one is a full bearing equivalent farm. So what we did is this farm that I just showed you the assumptions of, we introduced some volatility based on historic movement in things like prices, so prices in the various segments. Pack out percentages also varied, right? And what else did you, Yield, thank you. So yields, pack out percentages, and prices. We allow that to vary around the average projection in line with the variation that we see historically. Then we solve the thing 1,000 times and we get this risk distribution, and that's what you see here. So it's been split into 4 main categories. I think red speaks for itself as being negative. The yellow makes a small margin, but noting that from that small margin still needs to come those additional things that you need to pay, so it's still not necessarily a positive position. And then there's the 2 green ones, which is obviously starting to look a little bit better. At the top, you see the average result broken down in the 3, so top third, middle third, and bottom third segment coming from this. This is the full bearing one, so this is not accounting for replacement. I don't need to tell any of you that that's not where you would be in the long term. I think maybe something to look at in the short term while we're constraining hectares, but ultimately you would need to account for the cost of replacing orchards. So this is the one that's probably more relevant. And I think there you can see that in the short term it's not necessarily good news that we have for you, but then I think all of us probably already knew that. In the longer term, it does start to. So we're looking at another 2-3 years before things start to really turn around and settle down a little bit. The question, and I guess the challenge to us, is how do we change this picture? How do we make it look different? As I said, this is a baseline. This is business as usual, and I think we have all realized long ago that that's not going to cut it going forward anymore. So the first point I'll make is it's a very long value chain. It's very complex. I'm not going to try to run through all of these players, but there's a lot of them. I think that's the key point that we wanted to make. And if we want to ensure sustainability across the chain and volumes across the chain, we need to ensure sustainability at farm level. So I think it's going to take a little bit from everybody, from all of these role players across the chain to make this work. And if we can all make a small difference at the various nodes, we can ultimately get to a much better position on farm. So as I said, we need to try and see through the short term. One of the responses that we see, at least in our modeling framework, to get there is that people will curtail volumes a little bit. We may lose some area in the short term. And as I said, it's going to take a little bit from everybody to change it. We played around with a few. I think there's 3 scenarios that we'll show you quickly. This is just from our side, playing around with some ideas. I think there's probably hundreds more that we can run through the system. The nice thing is the system is set up so we can use it to look at different options. The first one that we did is very much at farm level, so that's what you as a producer can control. So what we did was to play around a little bit in terms of what our exports look like, to really optimize in terms of, firstly, maximizing our pack-out percentages for exports, but secondly, also what we put in there. So really targeting your class 1 fruit, your good quality, your optimum size fruit. But that obviously also comes at a cost. So we added some cost for labor, we added some cost for fertilizer, additional sprays. We increased the higher class 1 pack out with 10%, reduced the fruit going into processing by 10%, and then added a 15% in average export prices based on that, because we're now targeting your top quality fruit. So here I'm just showing again this is Kandas, this is the full bearing one, right? It's not so we're showing you not the one with replacement. On the left is the baseline, that's the one that you saw before. On the right is the impact of the scenarios. So there you can see this makes quite a significant difference already. Talking about a 40,000 per hectare improvement in 2024 on a full bearing equivalent farm. So that makes quite a significant difference already. The third one that we played around with is breaking down trade measures. Of course, this one, again, we have to caveat that these things take time. I think the industry's done great work in working with government to try and get it as effective and as quick as possible, but this isn't always a quick fix. We looked at India in particular, but of course it can come from anywhere. Here we looked at getting a better rate than the 30% tariff into India. That obviously would allow us to increase our exports into that market if we could access it more competitively. The open question becomes by how much, and I think that all of you probably know much better than we do. I think we were probably on the conservative end in terms of what we did, so we put a big push initially, so assuming that we do this in 2024, maybe it only happens in 2028, I don't know, but for lack of a better alternative. We doubled our exports into India that year, and then from there we just grow in line with the expectation for that market. So it's not penetrating additional at the expense of others over time, and I think there's probably opportunity to do that. What it gave us, you might ask me if we're crazy. If you look at those two charts, they look very similar. I think that they do look very much the same, and that's okay. If you look at the ones coming from the market model, though, you'll see that we reach that same level at a higher volume. So we keep more of our hectares. We don't lose those hectares. We're pushing more volume through the market, but without losing in terms of the sustainability and the profitability on farm. So I think that's a key aspect. And I think this one, you can play with that. You can play with this at length in terms of different markets, how much you can push into those markets, the time frame that you can do that, and each one will look different. The big kick that we really wanted to get to, this is scenario 4, but it's actually just a combination of the 3, is if we can get all 3 right together. Obviously, if we said earlier, if we can nail a few small things across the chain, we can make the ultimate difference. So that's all we've done here. The 3 scenarios that we've already described, we've imposed all 3 of them together on the model. And this is the picture that you then get. And I think all of you will agree, if you look at the one on the right-hand side, this one, if you look at all that green happening there, then we're getting to a level where we can sustainably increase hectares again, and maybe to a level where we can start to absorb the sort of volumes that we heard Justin talking about yesterday in that Vision 260. So I think that's probably our core message coming out of this. We recognize the challenges. It's probably not going to go away overnight. I think there's no silver bullet. There's no single switch that we can just flick to sort this out. I think there's a lot of things that need to happen at various points of this value chain to really solve it. And I think that's probably the crux of our message. There are still opportunities. If we can change a few things, if we can get a few things right, there can still be opportunities for this industry to grow. I think we need to find a way to survive the short term while making these changes. I think they are not, as I said, they're not changes that just occur overnight. Some of them will take time. And I think information is critical. So the better information base we can provide to everybody to coordinate from and to act collectively, the better we can do in terms of solving these problems. So thank you. That's my story.